Good afternoon, or good morning if you're in Australia. Oh, where did my screen go? Over here. It is about 19 minutes until the funds rate decision comes out. So will it be 25 basis points? Oh, shit. I either just woke up, sorry guys. Or is it going to be a pause, like no increase to the funds rate? I know that the popular opinion is a 25 point increase. We've already seen some volatility leading up to this decision, which is this red line right here. There was a really nice run all the way up to... I have to actually adjust this line because that's different now. Let me just drag this up here. There we go. There's our new high for the year, 28,736. And we've since dropped back below 28,500. Bit of a Bart Simpson, you know, up, chop, down. Anyway, while that's happening, what I'm going to do is just go and make a cup of coffee because I am really tired and I probably sound half asleep. So I'll be back. I'll leave this on. What is up, D Johnny? What's up, MG? Mo, Gianluca, Coley, Let's Mars. Glad you guys could make it. Alchemist, what's up? What's up, Alchemist? So yeah, bear with me. I'll be back in less than 15 minutes, hopefully. And we'll see what the market throws at us, and the FOMC. I think there should be a link for the live broadcast. I'll see if I can find it. 1 second. Federal. Oh, I found it. Live.
Information from all over the...
So there's a link in case you want to watch it as well. But let me go get this coffee. Yeah, alright, I'll be back. Go get the coffee.
Is conducting U.S. monetary policy, which involves influencing interest rates and the availability of money and credit in our economy.
Congress has tasked the Fed with implementing monetary policies that promote maximum employment and stable prices.
High levels of employment provide people with more economic opportunities, and stable prices promote growth
by making it easier for households and businesses to plan for the future.
Monetary policy decisions at the Fed are made by the Federal Open Market Committee,
which includes all 7 members of the Board of Governors and presidents from the reserve banks.
This committee meets regularly to assess the conditions and outlook for the economy.
In addition to conducting monetary policy, the Federal Reserve also helps to supervise and regulate the nation's banks and works to promote a stable financial system for consumers, communities, and businesses.
The Fed also works with communities, nonprofit organizations, and others across the nation to address housing problems, promote equal access to credit, and advance economic and community development.
The Fed also promotes stability in the financial system, because instability in the financial system can pose a severe threat to the broader economy and to communities across the nation.
The Fed also acts as a bank to other banks by clearing checks, making electronic payments, and providing the currency that Americans need and use every day.
Our nation's economy and financial system face constant challenges.
The Fed is working every day to address those challenges and is committed to helping foster good economic conditions and outcomes. Employment opportunities, stable prices, and financial stability that benefit all Americans.
And we are also the Fed.
To learn more about the Federal Reserve, you'll find a wide range of resources on the Board of Governors website at federalreserve.gov.
Jerome Powell is sexy. Thanks, Static. That's some great technical analysis right there. Man, look at the Federal Reserve's camera. That is shaky. You know what happens before this though? Wait, I'm gonna get demonetized, well not demonetized, but there's gonna be copyright for this video because of the music. Let me get this happening as well. What is it? It's the funds rate decision. Go today. There we go. Okay, this thingy, this doobie whacker. So eventually we're going to get those little spinning circles to reset. Man, it's weird without music. It's back. It's a doobie whacker. Yeah, doobie whacker. Have you ever, you haven't heard of that term before? It's like thingamajig. Thingamajig is another one. A doobie whacker. I'm gonna see if Google knows what a doobie whacker is. Doobie whacker. There's like no urban dictionary term for it. A whatchamacallit? Yes. Whatchamacallit, a doobie whacker, a thingamajig? Yeah. I learned a new word tonight, doobie whacker. Isn't it just one of those words that makes you want to run and open your Microsoft Word document where you keep a list of your favorite words? What's it mean? Same thing as a thingamabobber or a whatchamacallit? Any spelling or hyphenation corrections, please let me know. And also, yeah, there you go. So I wasn't crazy. A doobie whacker. Ah, Kevin, good afternoon. Glad you could join us. Little bit of a push here. Huge retracement, and now we're getting a bit of a rally. What is going on? I think the stock market still has a couple of hours left as well. It is a Wednesday, the Wednesday S&P 500 session. What did it throw our way? Let me just open up a new chart, just to have a little sneak peek of it. It threw, oh, nice. This is the 1 minute chart. So it's maintained some pretty nice levels here. It's still down for the day by 0.1%, but that's no big deal. Bit of a drop of 0.62% from the highest point here down to the low, but it seems to be rallying into the funds rate decision, so that's interesting. Let's go back to Bitcoin here. It is fast approaching. It is now 7 minutes or less till we get that decision. Now remember, after the decision comes the press conference half an hour later, so there's going to be a bit of market action between, I dare say, the funds rate decision and then the actual press conference where we hear Jerome Powell speak. So, and just casting my mind back to the previous funds rate stream, there was some volatility leading up to and after the decision, right? Like the funds rate coming out, but more volatility came in the press conference, like especially in the question time, like where Jerome Powell starts answering questions of the reporters. So we'll see that happen. So that'll be half an hour from the decision time, so 35 minutes from now. But yeah, I'm pretty sure, you know, the biggest options here are change to interest rate is either gonna be a 0% change, which is like the less popular option at the moment, or a 0.25% change, so 25 basis points. So, what will it be? Maybe I'll just do that to make it a bit more. That's pretty much it. It's either we're gonna get a pause, or a hike, another hike. We've had a whole series of hikes, as we all know. Now, obviously, an unlikely, but a shock would be a 50-point hike, which is definitely less likely, right? Or what is even less likely, I think, would be a cut to the interest rate of 25 basis points. I don't think that's gonna happen. I don't think we're getting a cut of minus 25 basis points. I think that happens after the pause. So I think we have to pause before we cut. That's usually what happens, historically speaking. But yeah, as the forecast tells us, it's a 25 basis point hike. That's what's expected. That's what's priced into the markets. That's what's most likely. Jack is up. Jack, you woke up the same time as me. Well done, my friend. It is hard for us Australians to get up and catch this. I had to wake up at 3:30 a.m. That's what my alarm was set for, 3:30 a.m. just to sort of get this stream happening. So yeah, you're welcome. Okay, so we know that the previous rate decision was a 25-point hike, and then the one before that was a 50, I'm pretty sure. But then the one before that was a 75, like 0.75% up in interest rates. That's very steep and fast. Like it's not often that they raise it that quickly. What's up, SHQ Cali? How are you, mate? And we've got Zach as well. What's up, Zach? Not quite g'day. Yeah, it's good morning. Good morning to you. Yo, look at this. We're pumping into the decision. We're still a couple of minutes out. Let me get that screen back up that gives us the actual result. See if we can get the little refresh button going here. Yep, there it is. The refresh button is live. I don't think that federal video is doing anything just yet, but I'll keep it down here anyway. Whoop. I'm gonna hide it. We don't need it just yet. Pumping into the decision, guys. I'm gonna delete this line. We don't need that now. We've got the 1 minute to go. We don't need that line anymore. And let's keep refreshing this rates decision. See if we can get that figure. We're expecting 5%. That's the total interest rate. So that would be an increase of 25 basis points, because we are currently sitting at 4.75% interest rate. Is there 30 seconds less? 10 seconds. Pipe. It's just going to be 5%. I'm pretty sure this is going to come out as 5. I mean, I've heard that the Fed does not like to surprise markets too much when they can help it. Ooh, look at this pump. Beautiful pump. What is going on? We haven't got the result yet. I'm still waiting for it. We're making a new high for the year. Awesome. We're gunning for 29,000. Yep, no, it came in as expected. There you go, 5%, 25 basis points. What did I tell you? So yeah, there we go, 25 basis points. So we're now at a 5% interest rate. Let me go back to that press conference video. Oh, they've got some government spiel video up here, giving us a bit of a history lesson, no doubt.
Courses are all free for educators to use in their lesson plans, or as they see fit. Many of the Federal Reserve System's regional reserve banks, located in 12 districts across the
mute
nation,
my music.
also offer in-person and online professional development that allows educators to deepen
Let's
their
listen to the
knowledge
nice
and hone
lady.
their craft when it comes to economics, personal finance, and more. Students too can take advantage of in-person opportunities by taking tours of exhibits in many of the 12 Federal Reserve banks around the country. Whether a student visits with their family or a school group, they get an in-depth look at how the Federal Reserve works to promote a healthy, sustainable
Bit
U.S.
of a
economy.
pullback.
At the Board and Reserve Banks, students also get hands-on opportunities like internships and participation on student boards, which introduce them to key economics concepts and potential careers in economics and finance. Consumers are empowered to make sound financial decisions
That
through the
is
availability of easy-to-understand
your
resources that
whipsaw.
explain personal finance
Classic.
concepts, the broader economy, and the Federal
Rip
Reserve's
up,
role in it.
rip down.
Federal Reserve Education is committed to equipping educators, educating students, and empowering consumers when it comes to understanding and participating in our evolving economy. For more information, visit federalreserveeducation.org to find links to resources and Reserve Bank programs offered near you, and follow Federal Reserve Education on Twitter at FedEconEd.
That's it, taking out liquidity in both directions, exactly. If there's an actual thing
is
called a
the Fed?
whipsaw.
So what is the Fed?
What is the Fed?
What is the Fed? The Federal Reserve, often referred to as the Fed, is the central bank of the United States.
Congress created the Fed in 1913 to help promote a safe and sound monetary and financial system for our nation.
The Fed includes the Board of Governors in Washington, D.C., which has 7 members, including the chairman and vice chairman.
All of the members of the board are appointed by the President of the United States and confirmed by the United States Senate.
The Fed also includes 12 regional Federal Reserve banks located in
Nice
several
haircut,
countries.
love. Look at her
The
haircut.
reserve banks serve as the central bank's operating arms and also gather economic information from all over
Back
the
up
country.
we go.
To help the Fed both monitor the economy and get the broad input necessary
to develop and implement effective U.S. monetary policy.
Today, the Fed performs a number of important functions, all with the ultimate goal of promoting a healthy U.S. economy.
One of the Fed's most recognizable functions is conducting U.S. monetary policy, which involves influencing interest rates and the availability of money and credit in our economy.
Congress has tasked the Fed with implementing monetary policies that promote maximum employment and stable prices.
High levels of employment provide people with more economic opportunities, and stable prices promote growth
by making it easier for households and businesses to plan for the future.
Monetary policy decisions at the Fed are made by the Federal Open Market Committee,
which includes all 7 members of the Board of Governors and presidents from the reserve banks.
This committee meets regularly to assess the conditions and outlook for the economy.
In addition to conducting monetary policy, the Federal Reserve also helps to
Doge Rocket.
supervise and
What's
regulate
up,
the
Doge
nation's
Rocket?
banks and works to promote a stable financial system for consumers, communities, and businesses.
The Fed also works with communities, nonprofit organizations, and others across the nation to address housing problems, promote equal access to credit, and advance economic and community development.
The Fed also promotes stability in the financial system because instability in the financial system can pose a severe
Well,
threat
actually,
to the
this
broader
is
economy
private,
and
isn't
communities
it?
across the nation.
The Fed also acts as a bank to other banks by clearing checks, making electronic payments, and providing the currency that Americans need and use every day.
Our nation's economy and financial system face constant challenges.
The Fed is working every day to address those challenges and is committed to helping foster good economic conditions and outcomes. Employment opportunities, stable prices, and financial stability that benefit all Americans.
And we are also the Fed.
To learn more about the Federal Reserve, you'll find a wide range of resources on the Board of Governors website at federalreserve.gov.
Pumping up again, look at that. It's all over the place. That is a crazy whipsaw. I don't know, have we seen it that violent on Fed Day? Let's get that music to come down a little. Dude, that is, yeah, that is some nice volatility. And if you've got the stomach to trade this, like, damn, that's really good volatility for Bitcoin. From bottom to top here, that's 2% swing in like within 10 minutes. Up and down, and climbing. Oh yeah, members are appointed by the government. Okay. I have to move this line now. We haven't yet tagged 29,000. It hasn't happened just yet. Let's just see where that is. That's up here, where this white line is. That's our 29k level. Let's get 28 on the screen as well. You see the stochastic RSIs going all over the place. I think we can get to 29. I reckon we can get there. Remember, it's the press conference that happens in about 23 minutes. That is interesting. Yeah, that can provide volatility. I better keep my voice down because the people in my house are still asleep. Sounds like there's a cat in this music. There's like a hiss and then a meow. Can you hear it? Bit of a dump. What is the SPY doing? Ooh, look at the S&P 500 pumping into the decision. That's crazy. That was the weirdest song. I thought someone was telling me to shush. That's why I was like, oh, I've got to be quiet. Sounded like someone was going shh. Good song. So S&P 500, they like the 25 basis point hike. So we're currently at a 5% inflation rate. I mean, interest rate. Interest rate, guys, interest rate. By the way, how has Trueflation been going? I haven't looked at this in a couple of days. Okay, look. This is the last 6 months. So this is since October. This website is suggesting that inflation is doing this. So it's down to almost 4%. You get a 1 week view on what's happened this week. Yeah, 4% basically, down from 4.23. There's the month. So they're suggesting that we're really getting things under control. There's only 2% left until we hit target of 2%. Man, wouldn't that be great? If anything like this happens, then damn. It means we're really getting things under control before the year is through. Maybe even like on schedule, like by July, July or August, something like that. Very nice. Anyway, we're just waiting out for Papa Powell, Jerome Powell, to come out and let us know what he thinks. Maybe the next decision is the pause. Because, guys, next month we don't get one of these. We don't get a funds rate decision next month. April, no funds rate decision, which means we are stuck at 5% for the time being until May. So May, very early May, I think it's the 4th of May. May the 4th be with you. May the 4th is the next funds rate decision. So either maybe that's when they do the pause, but this time around it wasn't a pause, it was another 25 basis point hike. Let's go to the interest rate chart. This is the interest rate right here. There's our little... Oh, this hasn't even updated yet, but our blue line is now up here at 5%. Almost on par with where the interest rates were back in 2006. And that's back when I was in high school. It's a long time ago. You can see we had it really good. Between here and here, there was basically no interest rate. It was just easy money, easy loans for the banks. And this was like 2015, it started to increase up. And see, before they made a cut, there was a pause. Now the cut had to happen quick because of COVID outbreak. I mean, actually no, they started cutting before COVID because this was June. June of 2019 was right here. So the interest rates were already getting cut by that time. But the really sharp point right here, where they just went from 1.75% interest rate all the way down to 0.25, which is basically zero. That all happened within one decision, like one FOMC meeting. They just made a huge drastic cut straight down. And then, as we know, COVID and inflation and whatever the Fed did with the money printer caused inflation to go out of control, and they had to respond with really aggressive hikes, a few of which were 75 basis point hikes. So that brings us up to where we are today at 5% overall. So that is the interest rate. It's been horrible in the past, like a 20 all the way up to 20% interest rate. That's crazy. Back in the 70s and 80s. I think early 80s, yeah. Late 70s, early 80s. But then looking at inflation, this is where we are. Inflation, we peaked at 9.1%. Something, a level we haven't been at since 1981. So we've had it kind of good. Like, things have been relatively under control, especially in the last 5 years, like 5 to 10 years. You know, it's been hovering around that 2% target inflation rate. It never sits still. Inflation is always on the move. Like, there's always something, there's always a change to it. Because it's such a broad measure of things, you know? There's so many different sectors, all of which are performing differently every month. So this is why, you know, this is never gonna read exactly the same, like 2 readings in a row. I think this, the closest we got was back here, where inflation was like bouncing in a very tight range at 1%, almost 1%. Very nice. Good times. That was the 60s. Beatles mania. Inflation spiked down at the COVID outbreak. I think basically everything spiked down. Forex spiked down, stocks spiked down, commodities, the inflation rate, the interest rate, crypto, everything spiked downward on that breakout of COVID. Like when it was, you know, I think March was when it happened. So yeah, it's so weird. There has to have been something that spiked up. You know, maybe gold, I don't know. I don't even think gold had a spike up. I think it spiked down too. The only thing that was spiking up was the infections. But that's another statistic, that's something else. But yeah, what a crazy moment in history. Like that's a moment for the history books. COVID-19 pandemic, like just crazy. Like what the hell? Like what the hell? It's like, shit, did that actually happen? You know? It was that unreal. Okay, let's go back to Bitcoin here. So there's your whipsaw effect. You know, especially in the first couple of minutes, you had this, you know. This is why it's very dangerous trading high leverage with no stop loss around the decision moment, because you get a bit of both. You get activity in both directions. So you got to be very careful what you're doing. Because it turns on a dime. It just goes up and then rockets back down. So are we going to reclaim 28.5? We're trying. Jerome is on the way. He's 20 minutes away. Sorry, 10 minutes. It's been 20 minutes since the decision. Watch live, March 22nd at 2:30 p.m. A very comfortable afternoon's press conference for them. No waking up at 3:30 a.m. What's up, Crypto Peter? Hello from South Florida, mate. Hello from Brisbane. I feel like I'm waking up to get on a flight or something. It's like so early. What's up, Skywalker? I'm well, thank you. May the force be with you. By the way, yes, a 25 basis point interest rate hike. So we are now at 5% interest rate. That's a very nice round number. They should just leave it at 5. Just, you know, pause the hikes, just let it sit at 5, and let's see how inflation likes that, you know? I mean, the banks are gonna hate it, surely. You know, it just got that little bit harder to borrow money. Or not harder, more expensive. It got that little bit more expensive to borrow money, or, you know, pay your mortgage back, or anything with repayments that involves interest rates. What a pain, you know? But it's necessary. Like, you know, if inflation's going up, it means there's too much cash flowing around. And that's not everyone's fault. That's not people's fault. It's just, it's a result of the government keeping the system afloat by producing more credit. Like, you know, essentially, like the general term is that they've turned the money printer on, right? They don't actually print money. I think that's the job of the mint or whatever. If you want to get down to technicals and semantics, you know. But, you know, everyone, we just say that they print money. So yeah, that's what happened. You know, when the world came to a standstill during the COVID pandemic, you know, like all the supply chains stopped or slowed to a grinding, you know, halt almost. The world slowed down and paused for like months on end. So to keep everything flowing and moving, governments around the world had to produce stimulus so that people could survive, you know, like to keep the lights on, basically. And that has caused a massive, like, burden of debt for starters, and inflation, like, went through the roof as a result. Like, maybe they went too heavy with, you know, their measures. Maybe it was an overreaction. I don't know. I'm not an expert, but all I know is that we're still paying for it. We're still feeling the effect of that economic, like, you know, ripple. I mean, honestly, it's nothing to complain about. I mean, we're here and healthy. We're, you know, my heart goes out to those that were affected by it. Sorry, you know, if you lost loved ones, my condolences. Like, what a horrible thing to go through. I hope nothing like that happens again in our lifetime. But here we are with, like, threats of war. Like, what the hell's gonna happen next? Alien invasion? It's just, yeah, wild shit happening left, right, and center lately. I'm trying to think, like, what was the craziest thing before COVID? Like, what was the most globally impactful? I'm thinking maybe, like, 9/11? Like, and then the whole, you know, the war in Iraq and Afghanistan, you know, all of that. That was maybe the previous most impactful thing, like, globally, that had, like, you know, like, a lot of countries got involved with that. So I mean, it has kind of been, you know, relatively stable for the last decade leading up to COVID. So, because, you know, like, maybe like in the moment, like during that time, I mean, there was the GFC. I mean, that was pretty big. The global financial crisis of 2008. The birth of Bitcoin, now that was a big deal, wasn't it? That was a positive deal. So crypto's been around since 2009. It was, but it didn't actually sort of like take off properly until 2010, I believe. Like that's when it became available more to, say, the public, like the broader public. Mount Gox, that kind of thing. I think you pretty much, like, if you were to get Bitcoin in 09, you had to be in the know. Like, you had to be in that circle. You either had to be a cryptography enthusiast, because I think that's how it all kicked off. It was a Reddit. I think it might have been like a Reddit group, like a cryptography interest group. You know how Reddit has all sorts of different, you know, / puppy dogs or / kittens or something, you know what I mean? Like Reddit groups. There was a cryptography one, and I think that's where it all started. So you can probably look up the Satoshi Nakamoto Reddit username and see when they last posted. Let me just see if I can find it. Satoshi Nakamoto Reddit. There's probably some famous posts on there. I don't even know, it might not have been Reddit. It might have been some other board that he was like communicating through. I don't know. You'll have to look up like some kind of documentary on the history of Bitcoin, but a website was launched along with Bitcoin, bitcoin.org, which I think still exists, of course. Bitcoin.org. Just see if I can find that site. Yeah, it's still there. So there'd be a team that maintained this website. They've got a legal page. Avoid scams, legal, privacy policy, press about Bitcoin's order. I wonder what their legal's like. Wow, there's a whole bunch of stuff. And like learn about your tax obligations. Compliance with tax obligations. Users of the website are solely responsible to determine what, if any, taxes apply to their Bitcoin transactions. The owners of or contributors to the website are not responsible for determining the taxes that apply to Bitcoin transactions yet. So it's up to the individual. Anyway, pretty interesting that they've still got that website going. Alright, this is the music that brings Jerome Powell to the stage. You have to like summon him through song and dance. Well, just song at least. And this is his walkout song, guys. Gets him all inspired to come out and tell us what the hell they're doing. I can just imagine him in a little tutu, like doing pirouettes as he comes out onto the stage with this music. Sounds like a little, I don't know, like an 8-year-old ballet recital or something. Oh shit, Aaron, what's up, man? Jerome Powell's gonna run out with a bunch. I think this is the music to sort of keep you calm when you're angry about the interest rate hike. It's like, it's okay. This is for your own good. It's like that government calm down music, you know? Calm down, everything's gonna be alright. Everything's under control, guys. We got this. We are professionals. We are trained professionals. We know exactly what we're doing. Oh look, it's all the professionals. All gearing up to ask the professional what he thinks or what he's gonna do. I'll shut up now. Make sure this is nice and loud. Give this a bit more real estate. There he is, the man of the hour.
Good afternoon. Before discussing today's meeting, let me briefly address recent developments in the banking sector. In the past 2 weeks, serious difficulties at a small number of banks have emerged. History has shown that isolated banking problems, if left unaddressed, can undermine confidence in healthy banks and threaten the ability of the banking system as a whole to play its vital role in supporting the savings and credit needs of households and businesses. That is why, in response to these events, the Federal Reserve, working with the Treasury Department and the FDIC, took decisive actions to protect the U.S. economy and to strengthen public confidence in our banking system. These actions demonstrate that all depositors' savings and the banking system are safe. With the support of the Treasury, the Federal Reserve Board created the Bank Term Funding Program to ensure that banks that hold safe and liquid assets can, if needed, borrow reserves against those assets at par. This program, along with our long-standing discount window, is effectively meeting the unusual funding needs that some banks have faced and makes clear that ample liquidity in the system is available. Our banking system is sound and resilient with strong capital and liquidity. We will continue to closely monitor conditions in the banking system and are prepared to use all of our tools as needed to keep it safe and sound. In addition, we are committed to learning the lessons from this episode and to work to prevent events like this from happening again. Turning to the broader economy and monetary policy, inflation remains too high and the labor market continues to be very tight. My colleagues and I understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 0.9%. Consumer spending appears to have picked up this quarter, although some of that strength may reflect the effects of swings in the weather across the turn of the year. In contrast, activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Committee participants generally expect subdued growth to continue. As shown in our summary of economic projections, the median projection for real GDP growth stands at just 0.4% this year and 1.2% next year, well below the median estimate of the longer-run normal growth rate. And nearly all participants see the risks to GDP growth as weighted to the downside. Yet the labor market remains extremely tight. Job gains have picked up in recent months, with employment rising by an average of 351,000 jobs per month over the last 3 months. The unemployment rate remained low in February at 3.6%. The labor force participation rate has edged up in recent months, and wage growth has shown some signs of easing. However, with job vacancies still very high, labor demand substantially exceeds the supply of available workers. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on wages and prices. The median unemployment rate projection in the SEP rises to 4.5% at the end of this year and 4.6% at the end of next year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in January, total PCE prices rose 5.4%, excluding the volatile food and energy categories. Excluding those, core PCE prices rose 4.7%. In February, the 12-month change in the CPI came in at 6%, and the change in the core CPI was 5.5%. Inflation has moderated somewhat since the middle of last year, but the strength of these recent readings indicates that inflation pressures continue to run high. The median projection in the SEP for total PCE inflation is 3.3% for this year, 2.5% next year, and 2.1% in 2025. The process of getting inflation back down to 2% has a long way to go and is likely to be bumpy. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a quarter percentage point, bringing the target range to 4.75% to 5%. And we are continuing the process of significantly reducing our securities holdings. Since our previous FOMC meeting, economic indicators have generally come in stronger than expected, demonstrating greater momentum in economic activity and inflation. We believe, however, that events in the banking system over the past 2 weeks are likely to result in tighter credit conditions for households and businesses, which would in turn affect economic outcomes. It is too soon to determine the extent of these effects, and therefore too soon to tell how monetary policy should respond. As a result, we no longer state that we anticipate that ongoing rate increases will be appropriate to quell inflation. Instead, we now anticipate that some additional policy firming may be appropriate. We will closely monitor incoming data and carefully assess the actual and expected effects of tighter credit conditions on economic activity, the labor market, and inflation. And our policy decisions will reflect that assessment. In our SEP, each FOMC participant wrote down an appropriate path for the federal funds rate based on what that participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 5.1% at the end of this year, 4.3% at the end of 2024, and 3.1% at the end of 2025. These are little changed from our December projections, reflecting offsetting factors. These projections are not a committee decision or plan. If the economy does not evolve as projected, the path for policy will adjust as appropriate to foster our maximum employment and price stability goals. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation. We remain committed to bringing inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening in labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thank you. Colby Smith with the Financial Times. How confident is the committee that the recent stress that we've seen and you've alluded to is contained at this point, and that deposit flight among mid-sized lenders in particular has ceased?
Thanks. So I guess our view is that the banking system is sound and it's resilient. It's got strong capital and liquidity. We took powerful actions with Treasury and the FDIC, which demonstrate that all depositors' savings are safe and that the banking system is safe. Deposit flows in the banking system have stabilized over the last week. And the last thing I'll say is that we're undertaking a thorough internal review that will identify where we can strengthen supervision and regulation.
Okay, just a quick follow-up. I mean, given all of the stress and the uncertainty that you've also alluded to in the statement, how seriously was a pause considered for this meeting?
So we did consider that in the days running up to the meeting, and you see the decision that we made, which I'll say a couple things about. First, it was supported by a very strong consensus, and I'll be happy to explain why. And really it is that the intermeeting data on inflation and the labor market came in stronger than expected, and really before the recent events, we were clearly on track to continue with ongoing rate hikes. In fact, as of a couple of weeks ago, it looked like we'd need to raise rates over the course of the year, more than we'd expected at the time of the SCP in December, the time of the December meeting. We are committed to restoring price stability, and all of the evidence says that the public has confidence that we will do so, that we'll bring inflation down to 2% over time. It is important that we sustain that confidence with our actions as well as our words. So we also assess, as I mentioned, that the events of the last 2 weeks are likely to result in some tightening of credit conditions for households and businesses, and thereby weigh on demand, on the labor market, and on inflation. Such a tightening in financial conditions would work in the same direction as rate tightening. In principle, as a matter of fact, you can think of it as being the equivalent of a rate hike, or perhaps more than that. Of course, it's not possible to make that assessment today with any precision whatsoever. So our decision was to move ahead with a 25 basis point hike and to change our guidance, as I mentioned, from ongoing hikes to some additional hikes maybe, some policy firming may be appropriate. So going forward, as I mentioned, in assessing the need for further hikes, we'll be focused, as always, on the incoming data and the evolving outlook, and in particular on our assessment of the actual and expected effects of credit tightening.
Mr. Chairman, can you explain the difference between ongoing rate increases and firming? Does firming imply a rate increase per se, or could policy firm without you increasing rates?
No, I think it's meant to refer to our policy rate. Really, I would focus on the words may and some, as opposed to ongoing. So we clearly what we were doing there was taking on board trying to reflect the uncertainty about what will happen. I mean, it's possible that this will turn out to have very modest effects. These events will turn out to be very, very modest effects on the economy, in which case, and inflation will continue to be strong, in which case, the path might look different. It's also possible that this potential tightening will contribute significant tightening in credit conditions over time, and in principle, if that means that monetary policy may have less work to do. We simply don't know.
Do you have concerns that the hike you did today could further exacerbate the problem in the banks?
No, I mean, with our monetary policy, we're really focused on macroeconomic outcomes. In particular, we're focused on this potential credit tightening and what can that produce in the way of tighter credit conditions. I think when we think about the situation in the banks, we're focused on our financial stability tools, in particular our lending facilities, the discount window, and also the new facility.
Nick Timmeros of the Wall Street Journal. Chair Powell, in your testimony 2 weeks ago, you had indicated you thought the terminal rate would be higher. Obviously, that was before the stress in the banking sector. And I realize there's a lot of uncertainty, but can you explain at all to what extent your forecasts or those of your colleagues or those of the board staff incorporated today a material tightening of credit availability because of the stress in the banking sector, or are you waiting to see it in the data before you incorporate that potential tightening into your forecasts?
So, we've just come from an FOMC meeting, and the people who write the minutes will be very carefully counting, but I'll tell you what I heard. What I heard was a significant number of people saying that they anticipated there would be some tightening of credit conditions, and that would really have the same effects as our policies do, and that therefore they were including that in their assessment, and that if that did turn out not to be the case, that in principle you'd need more rate hikes. So Some people did reflect that in their SEP forecasts. I think there may also just have been, remember, this is 12 days ago. You know, we're trying to assess something that just is so recent, and it's people, you know, it's very difficult. There's so much uncertainty. So December was a good place to start, and we wound up with very similar outcomes for December. And it, you know, in a way, the data in the first part, the first 5 weeks of the intermeeting period, pointed to stronger inflation and stronger labor market. So that pointed to higher rates, and then this latter part, kind of the possibility of credit conditions tightening, really offset that effectively.
To follow up, have you considered at all whether your primary tool, the funds rate, is going to be enough to sustain the kind of tighter financial conditions that you believe will be necessary without doing significant damage to the banking sector? Have you, for example, considered changing reserve requirements, selling assets out of the system, open market account, as a way to better achieve tighter financial conditions that don't accelerate deposit erosion, for example, from banks?
You know, we know that we have other tools in effect, but no, we think our monetary policy tool works, and we think, you know, many banks, our rate hikes were well telegraphed to the market, and many banks have managed to handle them.
Hi, Victoria Guida with Politico. I wanted to ask, you, along with the FDIC and the Treasury, the Fed Board decided to invoke the systemic risk exception to allow uninsured depositors to be protected at these two banks. And I was just wondering if you could speak to why that decision was made. Was it purely a confidence issue, or was there a concern that there would be some sort of economic contagion or financial contagion from the failure of these banks?
The issue was really not about those specific banks, but about the risk of a contagion to other banks and to the financial markets more broadly. That was the issue.
Okay, and then can you also, just to follow up, can you speak to the role that you will be playing in the Fed's internal investigation on its supervision and regulation?
So Vice Chair Barr is of course leading that review, and he's responsible for it in his capacity as Vice Chair for Supervision. I realized, you know, right away that there was going to be a need for a review. I mean, the question we were all asking ourselves over that first weekend was, how did this happen? And so what we did was early Monday morning we sat down and said, let's do this, and he was obviously going to lead it in his capacity. So I don't, you know, my role was to announce it, and I get briefed on it, but I'm not involved in the work of it.
Hi, Chair Powell. Howard Schneider from Reuters. So I want to go back to your February press conference. You mentioned the word disinflation, I believe, 9 or 10 times, a process that you felt was, I forget the word you used, but gratefully underway or something like that. Is disinflation still occurring in the U.S. today?
Yes. I mean, what actually happened, Howard, was I got the question 12 times. So maybe it's a feature, not a bug. But yeah, absolutely absolutely the same. The story is intact. So it's really three parts, right? Goods inflation's been coming down now for 6 months. It's proceeding more slowly than we would have liked, but it's certainly proceeding. Housing services is really a matter of time passing. We continue to see the new leases being signed at much lower levels of inflation. So that's 44% of the core PCE index, where you've got a story that's ongoing. Where we didn't have in February, and we still don't have now, is a sign of progress in the non-housing services sector, and that is, you know, that's just something that will have to come through softening demand, and perhaps some softening in labor market conditions. We don't see that yet, and that's of course 56% of the index. So the story is pretty much the same. I will say that the inflation data that we got, to your point, really pointed to stronger inflation.
If I could follow up on that, I was curious why you don't see more coming from the credit crunch, because it seems to me that's something that you'd actually welcome to a degree and expect. And are you not seeing more coming from that because you don't know, or because you just don't want to have another round of wishful thinking?
So it's really just a question of not knowing at this point. There's a great deal of literature on the connection between tighter credit conditions, economic activity, hiring, and inflation. Very large body of literature. The question is, how significant will this credit tightening be, and how sustained will it be? That's the issue. And we don't really see it yet. It's so people are making estimates, people are publishing estimates, and but it's very kind of rule of thumb guesswork almost at this point. But we think it's potentially quite real, and that argues for being alert as we go forward, as we think about further rate hikes. For us, we'll be paying attention to the actual and expected effects from that.
Hi, Chair Powell. Gina Smilik from the New York Times. Thank you for taking our questions. I wonder if you could talk a little bit, I know that you've got your internal review coming, but I wonder if you could talk a little bit about what you think happened with oversight at Silicon Valley Bank and whether this suggests that something about regulation and supervision needs to actually change going forward. And I wonder, how can the American people have confidence that there aren't other weaknesses out there in the banking system, given that this one got missed, as you noted?
So let me say what I think happened, and then I'll come to the questions around supervision. So at a basic level, Silicon Valley Bank management failed badly. They grew the bank very quickly. They exposed the bank to significant liquidity risk and interest rate risk, didn't hedge that risk. We now know that supervisors saw these risks and intervened. We know that the public saw all this. We know that SVB experienced an unprecedentedly rapid and massive bank run. So this is a very large group of connected depositors, concentrated group of connected depositors, in a very, very fast run, faster than the historical record would suggest. So as for us, so for our part, we're doing a review of supervision and regulation. My only interest is that we identify what went wrong here. How did this happen is the question. What went wrong? Try to find that. We will find that. And then make an assessment of what are the right policies to put in place so that it doesn't happen again, and then implement those policies. It would be inappropriate for me at this stage to offer my views on what the answers might be. I simply can't do that. Vice Chair Barr is leading this, and I think he's testifying next week. So, but that will be up to him. So that's really where it is. The review is going to be thorough and transparent. It is clear, to your last question, it's clear that we do need to strengthen supervision and regulation. And I assume that there will be recommendations coming out of the report, and I plan on supporting them and supporting their implementation.
And the final point, can we feel confident that these weaknesses don't exist elsewhere, given that they got missed at this bank?
These are not weaknesses that are at all broadly through the banking system. This was a bank that was an outlier in terms of both its percentage of uninsured deposits and in terms of its holdings of duration risk. And again, supervisors did get in there, and they were, as you know, obviously, they were on this issue, but nonetheless, this still happened. And so that's really the nature of the of the review, is to discover that.
Michael McKee from Bloomberg Radio and Television. You've been very consistent in saying that the Fed would be raising interest rates and then holding them there for quite some time. Following today's decision, the markets have now priced in one more increase in May, and then every meeting the rest of this year, they're pricing in rate cuts. Are they getting this totally wrong from the Fed, or is there something different about the way you're looking at it, given that you're now thinking that moves might be appropriate as opposed to ongoing?
So we published an SEP today, as you will have seen, and it shows that basically participants expect relatively slow growth, a gradual rebalancing of supply and demand in the labor market, with inflation moving down gradually. In that most likely case, if that happens, participants don't see rate cuts this year. They just don't. I would just say, as always, the path of the economy is uncertain, and policy is going to reflect what actually happens rather than what we write down in the SEP. But that's not our baseline expectation.
Well, if I could follow up and ask, as you look forward into the rest of the year here, are you saying that what you see and the 5.1% basically consensus is based on it will be sufficiently restrictive, or is it leavened by the idea of you don't know what's going to happen? In other words, what should people think about in terms of how the Fed thinks about how far it is from the terminal?
It's going to depend. Remember, we're looking, for purposes of our monetary policy tool, we're looking at what's happening among the banks and asking, is there going to be some tightening in credit conditions? And then we're thinking about that as effectively doing the same thing that rate hikes do. So in a way, that substitutes for rate hikes. So the key is we have to have policies got to be tight enough to bring inflation down to 2% over time. It doesn't all have to come from rate hikes. It can come from, tighter credit conditions. So that we're looking at, and it's highly uncertain how long the situation will be sustained or how significant any of those effects would be. So we're just going to have to watch. In the meantime, and obviously at the end of the day, we will do enough to bring inflation down to 2%. No one should doubt that.
Let's go to Rachel Siegel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions. I know we've talked a bit about how Silicon Valley Bank was unique to a certain sector of the economy, but there's also growing concern that there are financial stability risks from the commercial real estate market and loans that will begin to roll over later this year and next, and that smaller regional banks also disproportionately hold those loans. Is there a risk that could mimic the kind of what we saw with SVB to banks that disproportionately are focused in commercial real estate?
So, we're well aware of the concentrations people have in commercial real estate. I really don't think it's comparable to this. The banking system is strong, it is sound, it is resilient, it's well capitalized, and I really don't see that as at all analogous to this.
And one other question, would you be open to an independent investigation separate from the Fed's probe?
I welcome. It's 100% certainty that there will be independent investigations and outside investigations and all that. So we welcome, when a bank fails, there are investigations, and of course, we welcome that.
Edward.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. Inflation has been rather sticky, so do you need help from the fiscal side to get inflation down faster?
We don't assume that. We don't give advice to the fiscal authorities, and we assume that we take fiscal policy as it comes to our front door, stick it in our model along with a million other things, and we have responsibility for price stability. The Federal Reserve has responsibility for that, and nothing is going to change that. So we will get inflation down to 2% in time.
And if I could follow on that, but they're working, the spending that's happened is working against what you are doing, right? So it's prolonging inflation?
If you have to look at the impulse from spending, because spending was, of course, tremendously high during the pandemic, and then as the pandemic programs rolled off, spending actually came down. So the sort of fiscal impulse is actually not what's driving inflation right now. It was at the beginning, perhaps, part of what was driving inflation, but that's not really the story now.
Let's go to Neil Irwin.
Hi, Chair Powell. Neil Irwin with Axios. Two questions about aspects of the government's response on Silicon Valley Bank 2 weekends ago. First, why is this new bank funding facility done under Emergency 13.3 authority as opposed to expansion of the discount window, changing the terms of the discount window that's been around a long time? And second, can you discuss the Fed's role in the FDIC guarantee of uninsured depositors and why there's $143 billion on your balance sheet last week supporting that deposit guarantee?
Sure. So 13.3 seemed like the right, we have a little more flexibility under Section 13.3. We've done quite a lot under the discount window as well. We needed to do a special facility that was designed a certain way, so we did it under 13.3. Really no magic to that. It's only available in unusual and exigent circumstances, and it has to meet certain requirements, but it seemed to be the right place. So with the FDIC, we're lending to the, in effect, we're lending to the bridge bank. So that's where the funds came from, and it's a loan that's 100% guaranteed by the FDIC, so there's no risk in it for us.
Chris Rugaber.
Thank you. Chris Rugaber at Associated Press. The SEP suggests one more rate hike, as does the change in the language in the statement, in which suggests that you're perhaps nearing the end of a cycle of rate hikes. Do you feel, though, that if inflation remains high, you'll be able to resume additional hikes as needed, or have you somewhat tied your hands here with these signals about rate hikes coming to an end? Thank you.
Absolutely not. No, if we need to raise rates higher, we will. I think for now, though, as I've mentioned, we see the likelihood of credit tightening. We know that that can have an effect on the macroeconomy, on demand, on labor market, on inflation, and we're going to be watching to see what that is. And we'll also be watching what's happening with inflation and in the labor market. So we'll be watching all those things, and of course we will eventually get to tight enough policy to bring inflation down to 2%. We'll find ourselves at that place.
Hi, Chair Powell. Thanks for taking the question. Kyle Campbell with American Banker. I have a couple questions about the balance sheet. First of all, I'm curious at what point the financial supports that the Fed is extending through the discount window and through its enhanced lending facility might be at odds with the objective of reducing the balance sheet. And I'm also curious what your thoughts are on not just the availability of reserves, but the distribution of them throughout the banking system, and at what point you might be concerned about it being scarce for certain banks.
So people think of QE and QT in different ways, so let me be clear about how I'm thinking about these recent developments. So the recent liquidity provision that has increased the size of our balance sheet, but the intent and the effects of it are very different from when we expand our balance sheet through purchases of longer-term securities. Large-scale purchases of long-term securities are really meant to alter the stance of policy by pushing up the price and down the rates, longer-term rates, which supports demand through channels we understand fairly well. The balance sheet expansion is really temporary lending to banks to meet those special liquidity demands created by the recent tensions. It's not intended to directly alter the stance of monetary policy. We do believe that it's working. It's having its intended effect of bolstering confidence in the banking system and thereby forestalling what might otherwise have been an abrupt and outsized tightening in financial conditions. So that's working. In terms of the distribution of reserves, we don't see ourselves as running into reserve shortages. We think that our program of allowing our balance sheet to run off predictably and passively is working. And of course, we're always prepared to change that if that changes, but we don't see any evidence that that's changed.
Hi, Chair. Katerina Saraiva with Bloomberg News. The minutes of the January-February meeting, the last meeting, indicate that you discussed the possibility of runs on non-bank financial institutions and the impact of large unrealized losses on bank portfolios. Can you talk a little bit more about that discussion, kind of what was talked about in light of that? And then why didn't the Fed do anything about that at that point to ultimately prevent, what happened this month?
I mean, to be honest, I don't recall the specifics of that. It's quite an interesting 7 weeks, but I will tell you though that there have been presentations about interest rate risk. I mean, it's been in all the newspapers. It's not a surprise that there are institutions that have had unhedged long positions in long duration securities that have lost value as longer term rates have gone up due to our rate increases. So that's not a surprise. I think, as you know, as it is now on the public record, the supervisory team was apparently very much engaged with the bank repeatedly and was escalating, but nonetheless what happened. And so that's really the purpose of one way to think about the review that Vice Chair Barr is conducting, is to try to understand how that happened and try to understand how we can do better and what policies we need to change. I mean, one thing is the speed of I'll come back to that, the speed of the run. It's very different from what we've seen in the past, and it does kind of suggest that there's a need for possible regulatory and supervisory changes, just because supervision and regulation need to keep up with what's happening in the world.
Can you confirm whether or not the board knew about these escalations by the examiners in San Francisco?
I will have to come back to you on that. Yeah, I don't know.
Simon Urbanovich with The Economist. Thank you very much. Chair Powell, you've stated twice today that all depositors' savings in the banking system are safe. Are you saying that de facto deposit insurance covers all savings? Shouldn't Congress have a say in that? And just by way of example, if a bank with less than $1 billion in assets failed, are you promising to bail out all of its depositors? Thanks.
Well, I'm not saying anything more than I'm saying. So, but what I'm saying is you've seen that we have the tools to protect depositors when there's a threat of serious harm to the economy or to the financial system, and we're prepared to use those tools. And I think depositors should assume that their deposits are safe.
Go to Greg Robb.
Thank you, Chair Powell. Greg Robb from MarketWatch. I was wondering if you could give us a little bit more color. You gave just a little bit of color. You said during the first week of the Silicon Valley weekend, you said the question you guys asked was, how did this happen when you saw Silicon Valley Bank? So I was wondering if you could go to the Credit Suisse merger. I mean, wasn't that the big gorilla in the room? Didn't you breathe a sigh of relief when that merger happened? Thanks.
Sure. So, that was really the Swiss government. We, of course, were following it over the course of the weekend, and we were engaged with their authorities in the way that you would expect, all the ways that you would expect. It seems to have been a positive outcome in the sense that the transaction was agreed to, and it has been, the markets have accepted it, and it seems to have gone well, and I think there was a concern that it might not go well. So coming into the middle of this week, yes, I would say that has gone well so far.
Nicole.
Hi, thank you, Chair Powell. Nicole Goodkind with CNN Business. In the summary of economic projections, the FOMC sees the unemployment rate increasing to 4.5% this year. I'm wondering how you anticipate preventing this from snowballing while using the admittedly blunt tools at your disposal.
So that's an estimate of what will happen as demand slows and as conditions soften in the labor market. And it's a highly uncertain estimate. And I mean, there's really, we have to bring inflation down to 2%. The costs of bringing it down, there are real costs to bring it down to 2%, but the costs of failing are much higher. And if you read your history, as I'm sure you have, you can see that if the central bank doesn't get inflation back in place, make sure that inflation expectations remain anchored, you can have a long series of years where inflation is high and volatile, and it's hard to invest capital. It's hard for an economy to perform well, and we're looking to avoid that, and and to get back to where we need to be, back to where we were for a quarter century, and get there as quickly as we can.
But I guess the question is, historically, it's hard to.
Mr. Mike, please.
Yes, sir. Historically, it's been hard to contain unemployment, and the question is, do you worry about some sort of snowball effect, and how do you factor that into your projections and your thoughts?
Well, it depends on whether so recessions tend to be nonlinear, and so they're very hard to model. The models all work in a kind of linear way. If you have more of this, you get more of that. But when a recession happens, the reactions tend to be nonlinear, and that's so we don't know whether that'll happen this time. We don't know. If so, we don't know how significant it will be. And so, we're very focused on getting inflation down, because we know in the longer run that is the thing that will most benefit the people we serve. That's how we can have we've had very strong labor markets through these long expansions that we've had. 4 of the 5 longest, or 3 of the 4 longest expansions in U.S. history have been really since the high inflation period. And the reason was inflation wasn't forcing the central bank to come in and stop an incipient or an expansion. You can have very, very long expansions without high inflation, and we had several of those, and they're very good for people. You see late in an expansion, you see low unemployment, you see the benefits of wages going to people at the lower end of the wage spectrum. It's just a place that we should try to get back to.
Jean. Hi, Chair Powell. Jean Young with Market News. I just wanted to ask, with all the events of the past 2 weeks, do you still see a possibility of a soft landing for the U.S. economy?
It's too early to say really whether these events have had much of an effect. It's hard for me to see how they would have helped the possibility, but I guess I would just say it's too early to say whether there really have been changes in that. the question will be how long this period is sustained. The longer it's sustained, then the greater will be the likely declines in or tightening in credit standards, credit availability. So we'll just have to see. I do still think, though, that there's a pathway to that. I think that pathway still exists, and we're certainly trying to find it.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Just wondering how many financial institutions have been issued matters requiring attention or matters requiring immediate attention citations at this point?
How many? I don't know. But those are serious regulatory, particularly immediate attention. That's and I guess there were 6 of them. So.
And getting to the seriousness of it, how are you going to ensure that banks comply with these citations, take them seriously? How will you enforce them?
That is a great question and is right in the heart of what the review will be doing under Vice Chair Barr's leadership. So I think that's what you think about. What can we do to make sure? But again, that's not for me to answer today.
So you have specific thoughts on that?
Well, I see. If I did, I wouldn't share them because I really, this review's going on. And I want nothing other than us to find out what happened and why, figure out what we can do to do better, and then implement those changes. That's all I want. It's for me to be giving you my half-formed or partially informed thoughts. It just isn't appropriate. There's a real serious review going on with people from all over the Federal Reserve System who are not connected to this, to this work, not connected to this bank. And under again, Vice Chair Barr's leadership, and I'm confident that it will produce a satisfactory result.
Okay, we'll go to Jennifer for the last question.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. Curious, how do you view financial conditions right now? If credit becomes expensive enough, choking off growth, as you said you're watching for, would that situation warrant a rate cut? What situation would warrant a rate cut? And have the bank failures prompted any discussion around changing the implementation of the balance sheet runoff? Thank you.
So we haven't really talked about changing the balance sheet implementation. That's not something we've discussed yet. As I mentioned, we're always willing to change that if we conclude that it's appropriate, but we're really not seeing any signs there. Sorry, then the question before that was, just give me a...
Curious how you view financial conditions now, and if credit were
okay.
to tighten enough, if that would prompt a rate cut.
So financial conditions seem to have tightened, and probably by more than the traditional indexes say, because the traditional indexes are focused a lot on rates and equities, and they don't necessarily capture lending conditions. So we think that, though. So there are other measures which if they're focused on, bank lending conditions and things like that, they show some more tightening. The question for us, though, is how significant will that be, and how, what will be the extent of it, and what will be the duration of it, and then once you know that, there's a fair amount of research about how that with broad uncertainty bands, how that works its way into the economy over what period of time. And so, so we'll be looking to see the first part of that, like how serious is this, and how does it look like it's going to be sustained? And if it is, it could easily have a significant macroeconomic effect, and we would factor that into our policy decisions. I mentioned with rate cuts, rate cuts are not in our base case, so that's all I have to say. So,
Thank you.
Thank you very much.
Looks like that is it. For those who stuck around and watched the end of that boring ass Q&A. Alright, I'm gonna close that. Let's get the old music back on. Much better elevator music. The chart wasn't boring, exactly. So we've got ourselves a bit of a slip in price there. We've come down to almost 27K. a lot of that Q&A was just not well received by crypto, at least. I think maybe, let's check out the S&P on the 1 minute. Yeah, the S&P 500 didn't like it. But can it recover from it in the coming hours? Possibly. We'll see. How long does it have until it closes? Let's see. It closes in 44 minutes. The S&P. So we'll see if Bitcoin can get back on track with what it was doing. I mean, were we kind of expecting 25 basis points? Yes. You know, was there anything totally out of the blue with Jerome Powell being hawkish? No, that wasn't out of the blue. We've seen that before. I don't feel like a massive dump would be like confluent with the fact that, you know, all this should have been priced in. I don't know. We'll see. We'll see if this slows down and stabilizes, or whether we're in for a huge pivot and correction back to, you know, 20K or something deep like that. I don't know. We'll see. We are very elevated. We got up over, you know, we almost made a 29K touch only a matter of like a couple of hours ago. So that's, or, you know, during the FOMC thing. So yeah, let's wait and see how this settles down and what kind of trend we get out of it. If it's a downtrend that we get, then so be it. You know, just trade short until we get a pivot again and change direction. But yeah, it's still early. I'd give this a couple hours, let it settle into a trend. I mean, so far the trend is down. If you're looking at the last 1 hour, definitely a downtrend. Anyway, guys, I'm gonna go back to sleep because it is still really early here and I'm tired as hell. So thanks for tuning into the stream. I'll try to stream again soon and we'll sort of see what happened. We'll catch up with any developments, with any major moves. All right, cool. Well, have a great afternoon, have a great morning wherever you are, and I'll see you next time. Thank you.